Buffett's largest sale in 2024 was Apple, a stock that has historically performed well for him. He sold 605 million shares, worth $138 billion, or 44% of his portfolio. This raised questions since Apple has always been a company Buffett has praised. A clue to the reasoning behind this decision may lie in a comment made by Mark Zuckerberg, who suggested that Apple hasn't invented anything groundbreaking in a while. Sales of iPhones, a core product for Apple, have been stagnant since 2015, and there are indications that they might be declining. This lack of growth in Apple's key product could be a concern for shareholders. Despite slowing sales, Apple's stock has become more expensive over time. In 2012, its price-to-earnings (PE) ratio was 12, but now it has reached 37, despite the company's growth slowing down. This pricing doesn't seem rational given the company's performance, but Buffett has addressed the matter by citing tax purposes as one of the reasons for selling, though many believe the primary reason might be the combination of a high stock price and a slowing business model. In total, Buffett's sales in 2024 amounted to $153 billion, representing 57% of his current portfolio value of $266 billion. Warren Buffett's recent decision to sell a considerable portion of his portfolio has sparked much discussion. In 2024, Buffett sold $153 billion worth of stock, which amounts to about 36% of his entire portfolio. If we compare this to his past actions, it's clear this is an unusually aggressive move. In previous years, Berkshire Hathaway's net stock sales had never exceeded $25 billion in any given year, making this level of selling seem extraordinary. To further understand the magnitude, if you look at the total percentage of stock sales across all of Berkshire Hathaway's holdings, it's around 50.4% in 2024, according to Dataroma. So, what is Buffett doing with all the money from these sales? The key question here is not just what stocks he's selling, but where he's choosing to place his capital instead. One crucial shift that's occurred is Buffett's complete reversal when it comes to buying back shares of Berkshire Hathaway. For 6 consecutive years, he had been a consistent buyer of Berkshire's stock, using the funds generated from selling other investments to repurchase shares in his own company. However, in the third quarter of 2024, Buffett stopped this practice altogether and chose not to buy a single share of Berkshire Hathaway stock. This could be a clear signal that even Buffett believes the stock is currently overpriced, at least for the time being. If even Buffett, the man famous for his value investing approach, considers his own company's shares too expensive, this might indicate that he's adjusting his strategy based on the current market environment. So, where has he decided to park all the cash generated from the stock sales? A substantial amount of Berkshire Hathaway's cash has been funneled into short-term investments, particularly U.S. Treasury bills. These are low-risk, highly liquid securities backed by the U.S. government. As of 2024, Berkshire Hathaway holds $288 billion worth of Treasury bills, with a total cash and cash equivalents position now reaching $320 billion. This is double what the company had the previous year, when their cash reserves were $162 billion. This shift towards such conservative, risk-free investments raises the question: why is Buffett, who has historically been known for his bold investments in undervalued companies, now playing it safe with such a large portion of his portfolio? Buffett's recent actions seem to indicate a high level of caution. It's not just about the short-term market volatility. There may be deeper concerns about the long-term direction of the economy. If we look back at Buffett's past actions, specifically in 1969, we can see a similar pattern emerging. Back then, Buffett dissolved his investment partnership after growing disillusioned with the speculative nature of the stock market. During that time, the market was dominated by high-growth stocks in cutting-edge industries like technology and pharmaceuticals, collectively referred to as the Nifty 50. These companies were highly overvalued, and investors were willing to pay massive premiums, with price-to-earnings ratios as high as 50 times earnings. Buffett, however, saw the market for what it was, a speculative bubble, and chose to pull his money out, moving it to the sidelines. The next few years were marked by major economic challenges: 4 recessions, a dramatic stock market crash, the Arab oil embargo crisis, rising inflation, and high unemployment. Buffett's decision to step back from the market wasn't about having a crystal ball or predicting the exact timing of a crash. Instead, it was based on his understanding of stock valuations and market cycles. By recognizing that the market was overvalued and that good investment opportunities were scarce, he protected himself from the inevitable downturns that followed. While Buffett isn't exactly dissolving Berkshire Hathaway today, his decision to park significant amounts of cash in short-term, low-risk investments is a signal that he's becoming more cautious about the market. In fact, he seems to be preparing for the possibility of a downturn, much like he did in 1969. This doesn't mean that a crash is imminent, but Buffett's actions suggest that he believes current market conditions might not be sustainable in the long term. So, while this may not be a full-on repeat of his actions in the late 60s, the parallels are hard to ignore. By accumulating cash and avoiding overvalued stocks, Buffett is positioning himself for future opportunities, when the market corrects itself and undervalued companies become available once again. This strategy is about waiting for the right moment, much like preparing for a storm by stockpiling resources in a safe, secure place. Buffett may not be making big moves right now, but he's laying the groundwork for a stronger, more strategic position when the next big investment opportunity arises.